So it's a very good trade for individual investors. It's what I call an asymmetric trade. I mean, no guarantees, but the downside is limited because of the central bank demand, but the upside is unlimited because central banks are going to keep buying. Eventually, we'll get to the frenzy stage. We're not there yet.
Gold prices are on the rise, and the market is poised for significant changes. With central banks accumulating gold at an unprecedented rate, the stage is set for a potential buying frenzy that could reshape the landscape of precious metals. Let's explore what this means for investors with the help of Jim Rickards' insights.
Yeah, I've for a long time, go back 5 or 6 years, I had I said gold could go to $10,000 an ounce, and recently I revised that upward to, you do the math, you can update it, but kind of $25,000 an ounce. I should explain what that is. It's not well, it will get there, but it's not a hard forecast like, buy gold because it's going to $10,000 an ounce. Instead, it's an expression of it answers a question. The question is, what would the dollar price of gold have to be in order to have the dollar backed by gold?
The world of investing is constantly changing. As we navigate these shifts, understanding the dynamics of gold is crucial. Gold has long been viewed as a safe haven. Its value often rises when other assets falter. This makes it an essential consideration for any investor's portfolio. Recent trends indicate a growing demand for gold. Central banks are accumulating it at a remarkable pace.
In other words, whether you want a hard gold standard or soft gold standard or any kind of gold reference, why are we not in that system? And what would the price of gold have to be in order to be in that system? And the math is fairly simple. We can do calculus, but this is kind of seventh grade math, or at least where I went to school. So basically, take the money supply, and right away you run into problems. Everyone thinks they know what money is. Well, no, the Fed doesn't know what money is. They have M0, M1, M2. They have all. Whenever you see 5 different measures of money supply, it tells you right away that the Fed doesn't even know what money is. But
this signals a shift in how investors should approach their strategies. With the dollar's strength and fluctuating currencies, the landscape is ripe for exploration. The strength of the dollar. The dollar's recent performance has been noteworthy. It has gained strength against many currencies. The euro, for instance, has seen a decline. Just a while ago, it was trading at a higher rate. Now it hovers around $1.04. The Chinese yuan is in a similar predicament. It has weakened significantly, moving past the 7.3 mark against the dollar. This strength of the dollar often leads to a complex relationship with gold. Typically, a stronger dollar means a weaker gold price.
But anyway, I use M1. M0 is base money. That's the money the Fed prints, but it doesn't mean very much because they print it by buying securities from dealers, and the dealer sends in the 10-year notes or 5-year notes, and the Fed pays for the securities with cash. And that money does come out of thin air. That's not just a metaphor. It does come out of thin air, and they pay the banks. The question is, what do the banks do with it? They give it back to the Fed in the form of excess reserves. So all you're really doing, you're expanding both sides of the balance sheet. You're piling on Treasury securities, and you're piling up liabilities in the form of excess reserves.
However, the current situation is more nuanced. While the dollar is strong, gold continues to rise in value. This duality presents a unique opportunity for investors. Gold's performance against currencies. When we examine gold's performance, we see a different picture. Against various currencies, gold is on an upward trajectory. It is crucial to understand that while gold may be priced in dollars, its value is not solely tied to this currency. Gold is gaining against the euro, yen, and others. This trend indicates that while the dollar is robust, other currencies are struggling even more. The dollar may lead the pack, but gold is maintaining its strength. This suggests that gold is a valuable asset even in a strong dollar environment. Understanding supply and demand. The fundamental principles of supply and demand are at play in the gold market. Mining output has remained relatively flat over recent years. This stability in supply contrasts with the increasing demand for gold, especially from central banks. Central banks are making strategic purchases, adding to their reserves steadily. This scenario creates a classic supply-demand imbalance. With demand on the rise and supply stagnant, the price of gold is likely to increase. Investors should be aware of this dynamic. It highlights the importance of gold in their investment strategies. Retail investor trends. Despite the bullish outlook for gold, retail investors are not yet in a frenzy. Many are hesitant to buy, often waiting for prices to rise further. This reluctance may stem from various economic pressures. Some retail investors are selling gold instead of buying it. They might need cash or are uncertain about future price movements. However, this presents a unique opportunity for savvy investors. The current market conditions may favor those who act now. As central banks continue to buy, the stage is set for a potential surge in gold prices. Retail investors might soon find themselves scrambling to get in on the action. In the coming months, as the dollar's strength continues and central bank purchases increase, we may see a shift in retail investor behavior. As confidence grows, more individuals may seek to acquire gold. The time to prepare for this shift is now as the market evolves. Central bank buying patterns. Central banks are making significant moves in the gold market. Their buying patterns reflect a strategic shift in how they view gold as a reserve asset. This is not just a trend, it's a transformation in monetary policy. Countries are increasingly diversifying their reserves to include more gold. This shift is driven by the desire to reduce reliance on the dollar. Over the past decade, central banks have been consistent buyers. They have accumulated vast amounts of gold, often viewing it as a safety net. This trend is particularly evident in nations facing economic sanctions or geopolitical tensions. By holding gold, these countries safeguard their assets against potential financial instability. The buying patterns vary by country. Some nations are more transparent about their gold purchases, while others keep it under wraps. However, the overall trend is clear. Central banks are leaning heavily towards gold. This consistent demand plays a crucial role in stabilizing gold prices in unpredictable markets. The role of Russia in gold accumulation. Russia's gold accumulation strategy is noteworthy. For over a decade, Russia has been building its gold reserves. This has provided a cushion against sanctions and economic pressures. By 2022, they had around 25% of their reserves in gold. This strategic move has helped Russia withstand various economic challenges. The conflict in Ukraine has highlighted the importance of this strategy. When the US froze Russian treasury assets, the gold reserves remained untouched. This illustrates the benefit of holding physical assets. Gold is not subject to the same vulnerabilities as digital or fiat currencies. Countries like China and India are following suit. They are increasing their gold reserves to enhance financial security. As these nations accumulate gold, the global demand continues to rise. This creates a ripple effect in the market, influencing prices and investor behavior. The implications of frozen assets. The freezing of assets has significant implications for global finance. Countries are now reconsidering their reliance on the dollar. Trust in the US financial system is waning. This has led many to explore alternative assets, such as gold. For nations with large dollar reserves, the risk is clear. They could face similar situations as Russia. This uncertainty pushes them towards gold as a safeguard. The implications extend beyond individual nations. They affect global market dynamics and investor confidence. As countries diversify their reserves, gold becomes a focal point. This trend could lead to increased volatility in the dollar. Investors must remain vigilant. The landscape is shifting, and understanding these implications is crucial for strategic decision-making. Global central bank strategies. Global central banks are adopting varied strategies in their gold accumulation. Each country has its unique approach based on economic conditions and geopolitical risks. However, the overarching strategy is clear. Increase gold reserves. Central banks are not just buying gold indiscriminately. They are strategic in their purchases. They often buy during market dips, ensuring they acquire gold at advantageous prices. This calculated approach helps stabilize their reserves while also influencing market prices. In this environment, gold has become more than just a commodity. It is a strategic asset that provides security. As central banks continue this trend, the demand for gold will likely increase. This could lead to higher prices and a more robust market in the long term. The current demand landscape. The current demand for gold paints a complex picture. On one hand, central banks are buying steadily. On the other hand, retail investors remain cautious. This dichotomy creates an interesting dynamic in the market. The demand landscape is evolving. As more investors recognize the value of gold, participation may increase. Understanding this shift is essential for anyone considering an investment in gold. The stage is set for potential growth, and being informed is crucial. The asymmetric trade of gold. Gold represents what I call an asymmetric trade for individual investors. The potential downside is limited, primarily due to the consistent demand from central banks. On the flip side, the upside is virtually unlimited. Central banks are committed to accumulating gold. As their buying patterns evolve, we are likely to witness a frenzy in the market. This unique situation makes gold an attractive investment. Unlike many assets, which can be subject to significant volatility, gold is anchored by the actions of central banks. Their steady demand acts as a safety net for investors. This creates a scenario where investors can potentially reap substantial rewards while facing relatively low risk. Calculating price increases. Understanding the mathematics behind price increases in gold is essential. As the price of gold rises, the increments of price changes can feel less impactful in percentage terms. For instance, moving from $2,700 to $2,800 is a $100 increase. However, in percentage terms, that increase represents a smaller gain as the base price rises. When gold reaches $3,000, the percentage increase from that point will be less than it was at lower prices. This dynamic makes it easier for gold to continue rising. Each increment becomes a smaller percentage of the total. As a result, as prices climb, public interest tends to grow. This could lead to an influx of new buyers, further driving demand. Psychological price thresholds. Psychological price thresholds play a crucial role in market behavior. The $3,000 mark is one such threshold. Crossing this boundary often captures the public's attention. Investors tend to flock to assets that are perceived as surging in value. Once gold crosses this key level, we can expect a surge in interest from retail investors. Historically, many tend to buy when prices are high rather than when they are low. This is just human nature. The buzz around the $3,000 mark could trigger a buying spree. It's essential to consider this when planning your investment strategy. Looking ahead, the trends in gold investment seem promising. Central banks will likely continue their strategic accumulation. This consistent demand will support higher prices. Additionally, as geopolitical tensions rise, gold will remain an attractive safe haven. As we approach these psychological thresholds, expect a shift in retail investor behavior. Interest in gold may spike as prices rise. Investors should be proactive. The time to act is now, before the frenzy begins. Preparing for the future, navigating economic tides, and securing your financial well-being. As we gaze into the horizon of the future, the intricate dance of economic dynamics demands our keenest attention. The interwoven threads of government actions, the relentless push and pull of market forces, and the myriad individual choices we make collectively sculpt the contours of our financial destinies. To navigate this complex terrain effectively, a proactive and informed approach is not merely advisable, but absolutely essential. Understanding the fundamental principles that govern economic cycles, from periods of robust growth to inevitable contractions, equips us with the foresight to anticipate potential challenges and capitalize on emerging opportunities. We must delve beyond surface-level observations and strive to comprehend the underlying mechanisms that drive inflation, interest rates, and currency fluctuations. This involves staying abreast of macroeconomic indicators, analyzing policy decisions from central banks and governments, and recognizing the global interconnectedness of financial markets. Within this landscape of uncertainty, certain assets have historically demonstrated their resilience and enduring value. Gold, in particular, stands out as a time-honored beacon of stability amidst turbulent seas. Its historical significance as a medium of exchange and a store of wealth stretches back millennia, ingrained in human civilization across cultures. Unlike fiat currencies, which are susceptible to inflationary pressures and the whims of governmental policies, gold possesses an intrinsic value rooted in its scarcity, durability, and universal appeal. In times of economic instability, geopolitical unrest, or concerns about currency devaluation, investors often turn to gold as a safe haven, bolstering its demand and potentially driving its price upwards. However, relying solely on a single asset class, even one as historically reliable as gold, is rarely a prudent strategy. The cornerstone of robust financial preparedness lies in diversification. Spreading investments across a range of asset classes, such as equities, bonds, real estate, and commodities, including gold, helps to mitigate risk. When one sector experiences a downturn, others may hold steady or even appreciate, cushioning the overall impact on a portfolio. This diversification should also extend geographically, recognizing that economic conditions and growth prospects vary across different regions. Timing your investment in gold is indeed a crucial consideration. Current market conditions suggest a potentially opportune moment for acquisition. The robust demand emanating from central banks, coupled with a relatively stable supply, creates a fundamental imbalance that often favors price appreciation. Central banks, as significant holders of reserves, often increase their gold holdings during times of economic uncertainty or to diversify their assets away from sovereign debt. This sustained demand provides a strong underlying support for gold prices. Furthermore, the current stability in supply, without significant new mining discoveries or influxes into the market, reinforces this positive outlook for potential price increases. As we approach critical price thresholds, the dynamics of the gold market are likely to shift. The potential for a surge in retail investor participation looms large. Historically, once gold prices begin to exhibit strong upward momentum and break through key resistance levels, it often attracts the attention of individual investors seeking to preserve capital or capitalize on perceived gains. This influx of retail demand can act as a powerful catalyst, further propelling prices upwards and potentially creating a more rapid and significant price appreciation. Being proactive and establishing a position before this widespread retail interest materializes can offer a significant advantage, allowing investors to potentially benefit from the earlier stages of a price rally. To translate this understanding into actionable steps, with a particular focus on the current opportunity presented by gold, individuals should embark on a continuous journey of financial literacy and proactive management, incorporating the following steps. Cultivate financial literacy. Educate yourself. Dedicate time to learning about basic economic principles, different investment vehicles, and personal finance strategies, with specific attention to how gold performs in various economic environments. Explore reputable books, articles, online courses, and seminars focusing on precious metals investing. Stay informed. Regularly follow financial news from reliable sources, paying close attention to reports on central bank gold purchases, global supply and demand dynamics for gold, and macroeconomic indicators that historically influence gold prices, such as inflation and interest rate expectations. Seek professional advice. Consider consulting with a qualified financial advisor who has experience in precious metals and can provide personalized guidance based on your individual circumstances, risk tolerance, and long-term goals, specifically regarding the allocation of gold within your portfolio. Develop a comprehensive financial plan. Define your goals. Clearly articulate your short-term and long-term financial objectives, including how gold fits into your overall wealth preservation or growth strategy. Assess your current situation. Understand your income, expenses, assets, and liabilities to determine an appropriate allocation to gold without compromising other essential investment areas. Create a budget. Develop a realistic budget to ensure you have the capital available for a considered investment in gold without incurring undue financial strain. Establish an emergency fund. Ensure you have a sufficient emergency fund in place before allocating significant capital to gold, as gold investments may not be easily liquidable in the short term. Implement a timely and diversified investment strategy. With a focus on gold, understand your risk tolerance. Specific to gold, recognize that while gold is often seen as a safe haven, its price can still fluctuate. Determine your comfort level with potential short-term price volatility in gold. Allocate assets. Strategically, considering the current gold market. Based on your goals, time horizon, and risk tolerance, and acknowledging the current favorable conditions for gold, determine an appropriate allocation to gold within your diversified portfolio. This might involve a higher initial allocation to gold than you might consider in different market circumstances. Choose your method of gold investment. Explore different ways to invest in gold, including physical gold, coins or bars, gold ETFs, exchange-traded funds, or shares in reputable gold mining companies. Each method has its own advantages and disadvantages regarding storage, liquidity, and cost. Consider phased entry. Instead of investing a large sum all at once, consider a strategy of phased entry, buying gold at regular intervals. This can help to mitigate the risk of investing a significant amount at a potential short-term peak. Monitor price thresholds, pay attention to key price levels and technical indicators for gold. As the market approaches critical thresholds, be prepared to potentially increase your allocation or adjust your strategy based on how the market reacts. Act before the potential retail rush. Given the current indicators of strong central bank demand and stable supply, consider initiating or increasing your gold holdings proactively before a potential surge in retail investor interest could drive prices significantly higher. This requires timely decision-making and execution. Regularly review and rebalance. Periodically review your overall portfolio, including your gold holdings, to ensure it still aligns with your goals and risk tolerance. Rebalancing may involve adjusting your gold allocation based on its performance relative to other assets and changes in market conditions. Embrace continuous vigilance and adaptability. Stay alert to gold market dynamics. Continuously monitor factors specifically influencing the gold market, such as central bank policies, geopolitical events, inflation data, and global economic growth prospects. Be patient and disciplined with your gold investment. Understand that gold's role in a portfolio is often as a long-term store of value and a hedge against broader market risks. Avoid impulsive selling based on short-term price fluctuations. Continuously learn and adapt your gold strategy. Stay updated on new developments and analyses within the gold market. Be prepared to adjust your investment approach if the fundamental drivers of gold prices change significantly. In conclusion, preparing for the future necessitates a proactive and informed approach to financial management, with a keen understanding of economic dynamics and the strategic role of various asset classes. The current confluence of factors in the gold market presents a potentially compelling opportunity for investors to consider increasing their exposure to this precious metal. By combining financial literacy with a well-defined plan, a timely and diversified investment strategy that thoughtfully incorporates gold, and continuous vigilance, individuals can navigate the uncertainties of the economic landscape and strive towards greater financial security and prosperity. Acting strategically and with informed awareness of the current market dynamics in gold may offer a significant advantage in securing your financial well-being for the future. If you're concerned about your financial security and are thinking about Interactive Brokers, click the link to learn more. If you enjoyed this video, please give it a thumbs up and subscribe to our YouTube channel for more great content.